5-minute warning.
Good morning, I am Aiden from TRADARS. Let us speed on the evolving macro landscape. The market is navigating moderate risk off and moderate risk significantly influenced by stabilizing U.S. as investors react to a significant cooling of fixed income markets. The U.S. 10-year yield has retreated by 9.8 basis points since yesterday, a move that is simultaneously dampening the U.S. dollar's strength and providing a precarious floor for European equities. Biggest movers right now, volatility index and natural gas are down. Silver, platinum, and gold are up. Well, well, well. Sorry, I need 2 more minutes. Good morning, I'm Aiden from TRADARS. Let us get you up to speed with the latest. Good morning, I'm Aiden from TRADARS. I'm observing a market. Good morning, I'm Aiden from TRADARS. Let us get you up to speed. Good morning, I'm Aiden from TRADARS. Let us get you up to speed with the latest market trends. I am observing a market in a moderate risk-off state that is currently stabilizing as investors react to a significant cooling in fixed income markets. The U.S. 10-year yield has retreated by 9.8 basis points since yesterday, a move that is simultaneously dampening the U.S. dollar's strength, providing a precarious. All right, I think we got it. Let's go! Hey, hey, hey. Welcome to Forex.Today, the YouTube community of more than 21, almost 22,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance. S&P 500 down, VIX is down, Bitcoin is down, gold is up, WTI 103. Is it up? Is it down? Is it sideways? U.S. dollar still over 100. And oh my goodness, look at the move on yields. Holy schnicker. What it means is yields are down on the 10-year, which means money is going in. Holy smokes. But anyways, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Oh my goodness. So yeah, let's jump into the main screen here and get on with it. Good morning, I'm Aiden from TRADARS. Let us get you up to speed with the latest market shifts. I am observing a market in a moderate risk-off state that is currently stabilizing as investors react to a significant cooling in fixed income markets. The US 10-year yield has retreated by 9.8 basis points since yesterday, a move that is simultaneously dampening the US dollar's strength and providing a precarious floor for European equities. Biggest movers right now, volatility index and natural gas are down. Silver, platinum, and gold are up.
Silver, platinum, gold are up. Very cool, huh? Let's get an update on the headlines.
South Africa trade balance in rands rose from previous 9.31B to 36.92B in February. Crypto today. Bitcoin, Ethereum holds steady amid ETF inflows. XRP extends decline.
Trump criticizes UK and France, urges allies to secure their own oil routes.
Yen. BOJ may advance hike on Iran. Conflict risk. Commerzbank. French inflation strongest since 2024.
Pound yen price analysis. Pound remains weak below 211 $. Investing live European FX news wrap. Eurozone inflation picks up. Renewed deal optimism.
US dollar. Energy shock supports strength as Fed stays cautious. MUFG.
So with this, these recent headlines, like for example, Bank of Japan may advance a rate hike. Cool. Well, we've talked about how the Fed, as an example, if they raise interest rates, that I don't think it'll have an impact on inflation in the United States because easy money is not what is creating inflation. So you have demand side and supply side of the equation. So let's say demand side.
INR. Realized flows show heavy selling. BNY.
So demand side inflation is caused by everyone being rich and everyone's fighting to buy the same amount of products. There's lots of demand, but there's not enough stuff to buy. So there's a scarcity of products and services. Okay, so it's kind of like trying to get your driveway poured. You know, you need new concrete, but you can't find any workers to do it. Right? So the prices are high, the quality is low because there's a scarcity of workers or something, right? Okay, so in that case, if too many people have too much money and they're spending more money than the economy can possibly handle, then you could raise interest rates, make money more expensive, make money more scarce. And then the demand for products and services gets
giant
diminished.
Oil tanker ablaze off Dubai after Trump warnings. Russian oil tanker enters anchorage of Cuba's Matanzas port, ship data says.
Right? So anyways, we have an exogenous supply issue, not a demand issue. So you can raise or lower interest rates all you want. It will not impact how much oil is available, nor will it change the perceived threat of maybe oil not being available. You see? Now, Bank of Japan's different. Why is it different? Japan has to buy their energy. So now they have to spend more yen to buy the same amount of energy. Can't do anything about the price, but you can do something about the purchasing power of the yen. The weaker the yen, the more you have to spend. Plus, the higher the price, the more you have to spend. It's a double-edged sword. It's a double whammy. Okay, it's compounding. A weaker yen and a higher price means more and more and more and more and more yen. Okay, so they could say, you know what? If we can have a policy at the Bank of Japan that would strengthen the yen, think of it as yen intervention, then if the value of the yen goes up, then it will buy more oil. It'll buy more energy. And that's what they need, eh? So that makes sense for Japan. Doesn't make sense for the United States to raise interest rates, but it makes sense for Japan. We also have intervention or potential intervention from the Swiss National Bank. So this gets interesting. The central banks are designing strategies to deal with the high oil prices. Okay, risk is bad, but yesterday was an improved day. In fact, vol dropped. We went from almost 32 to almost 28. 28 is terrible. Okay, absolutely terrible. So it's way higher than it has been, but it's dropped significantly yesterday. So we'll take that drop, and then we'll wait it. Yeah, cool. So anyway, so things are still bad, but when you look at last week being less bad than the last 4 weeks, and then yesterday actually being good, look, we're not in the free and clear, but it's just not the same as it was 24 hours ago. And that's good to know, isn't it? Because your job isn't to beat the market. Your job is to line yourself up with the market. So watch the headline. Okay. For example, what happens if Trump sends in the Marines? All hell breaks loose, right? Okay, well, that'll probably increase our risk, one would assume. Yeah. Now, I'm not sure why they would go after Kurg Island, but maybe just because it would bother Iran. Like, what is it, 90% of their energy? But that doesn't solve, I mean, what is that? What does it solve? We don't care where the oil comes from, per se. If Iran is no longer a terrorist threat or has nuclear capability as a threat, so you got to get rid of Hamas, got to get rid of the Houthi mamas, okay, so on and so forth, right? That's the thought. And then you take their enriched uranium, and then you're like, okay, well, play nice with the rest of the world, Iran, and we welcome your oil, right? Like, that's kind of where you need to get. Taking the oil, I don't know. What does it do? We need the oil out. We don't need to own the oil. But whatever. I'm babbling here. So the thing is, this is why I'm babbling. There's a lot of things that can change this. So yesterday was a decent day. Great. But a lot of things can still go wrong. And it could be one tweet away from victory or retreat in your trading, right? Yeah. Now, one of the things that you probably know from me, because I talk about it almost every day, probably every day, but I preach to teach, right? Is that this time of year I like to start accumulating risk. And then suddenly the Monday of the week that I want to start accumulating risk, we have our first bullish day in like forever. I don't know. Probably just coincidence, but maybe not coincidence. I don't know. But kind of interesting, isn't it? So let's see what you guys said. Yeah, risk on, risk off, basically 50-50, huh? Well, Gregors, I've been, you know, I've been looking at prices, and well, I, yeah, I'm out there. I'm participating in the market, Greg. We'll put it that way. Oh, spike radar. This is working on the back end, and 2.5 is working. What's going on here? I've been using the spike radar all morning. Maybe I got to refresh my browser. Control Alt R. Hard detection. Huh. Well, hell's bells. So it's not publishing to the front end. Interesting. But it's working here, though. Here. At least it was. Hey, Dad. Oh, no. It is working. I guess you must be doing something funny like trying to load, the whole year in advance instead of just like load the next few days in advance. I don't know. Let me talk over it. I want to see if it actually loads. It's there. It works. But yeah, if he's trying to, instead of just like what a database would do is load it and cache it, and you don't need a whole year in advance, nor do you need to go back 30 years of data and load it every time, that kind of thing. And it's probably just doing a silly mistake. But nonetheless, we do face, the key risk here that we face is high oil prices on exogenous supply shocks. Now, I think we're pretty close to 50% of the oil that is supposed to go through the Strait of Hormuz every day. 50% is getting out in other means. So now we're down to essentially 10% of the world's supply is just sitting around. Remember, we have it. We have the oil. We have oil in tankers. We have them in tanks. In fact, we have so much of it, we've stopped producing newer stuff. Now, so that means maybe in 3 months, let's say the war ends very, very soon, and in 3 months, we'll kind of drain out our storage. And you can't just flip a light switch and turn on and turn off oil production. So if we've turned off oil production in places like Iraq, well, it takes time to turn it back on. Huh, this is just not going to work. All right, I'll figure that out. No big deal. So what we're seeing now, and I don't know if you noticed this, but the spread between Brent and WTI is back to normal. I don't know if you noticed that. It happened last night. We went, so there's normally a $4 or $5 spread between WTI and Brent. That would be normal. And then at some point we got to almost $20. And we talked about that, and I'm like, oh my goodness. Done. Right? $20 spread between the two. And now it's back to about $4 or $5. Now, part of it is Brent has come down a bit, but also WTI has gone up. Because now we're seeing that for those countries that are not getting oil, so let's just say China. China is not getting the oil that they paid for, that they bought. It's sitting there, right, in the Persian Gulf. Or it's sitting in a storage facility in Iraq. It's been bought, it's been paid for, or at least financed, but it's not arrived. So what happens is then China scrambles to find any available supply that just might be out there and gather all that up. And I imagine they've done all of that. And so now you get to the point where you're like, we need to buy some from America. Huh? We need God's oil. Right? So Texas, right? Yeah. Which by definition is heaven. Right? So anyways, Texas. You start buying some of that Texas tea. And then now it pushes up WTI price. So we were at 88, now we're at 100. And Brent was 115, but now it's 105. Or, I'm playing with the numbers slightly different. I think we're at 103 and it's at 108. But the spread is normalized because the price shot up for Brent first and now has gone up for WTI. And they're back to sort of a normal level as these supply chains actually shift. It's a really interesting thing to pay attention to. So at Harvard, in my energy class, we were tracking the Fukushima nuclear reactor meltdown in Japan that happened around, what was it, Christmas? I don't know, 8 years ago, whatever it was, 10 years ago. And then suddenly, Japan had a shortage of energy because the nuclear power plant was taken down. And then a few days later, all nuclear power plants have been taken. So now you have to then create energy from things like nat gas. And nat gas is really interesting because this is what we were studying. Nat gas was flowing out of the Straits of Hormuz and was on its way somewhere to whatever customer. And then they realized suddenly, boop, Japan needs this energy, like it's a desperate situation. And the ships turn around at sea. They turn around and they all go to Japan. How cool is that? You can't do that with a pipeline. Yeah. I was on an app the other day tracking all ships at sea and globally in real time. And then I went into the Straits of Hormuz and saw the number of ships that are on one side or the other side. There's ships on both sides. They can't get in, they can't get out. Remember, it's $200,000 a day to have an oil tanker. So let's say you're going to move your oil. You have oil, and you have a customer somewhere in the world, and you're like, okay, I'll get you my oil. I'm going to ship it to you. FedEx ain't available. UPS ain't available. So I'm going to use a shipping container. So you load your not your shipping container, sorry, your oil tanker, right? Okay. So now you rent an oil tanker. $200,000 a day. So if it's anchored, $200,000 a day. $200,000 a day. One reason why oil prices go high, because by the time this is resolved and we bring it into port, let's say the cost of that oil, right, has gone up $100 million. $200,000 a day, for 50 days or whatever, you see? Okay, silver up, gold up. Cool. Now gold is still below my my price, let's say. because I've been buying on the way down. But it's going in the right direction. It's stabilizing, but you have to also understand my positions are hedged. So even if it's just going up slowly, I'm totally fine. I don't want to see gold at 3,500. That just hurts, right? Even if you're hedged, you're like, oh my God. But if it's farting around 4,500, maybe one day, like in a month, in a year, in 10 years, we're back to 5,500. Cool. I'm fine with that. Whatever. Because I'm still making money. That's the cool thing about investing. By the way, if you love trading, oh my God, you're going to love investing as well. Yeah. Because then you get to, like, trading, you're usually, what most people do is you're quite short term. Like, you're never in a trade more than 4 or 5 days. So you're constantly trying to create alpha. You're not really trying to hedge. You're not really trying to make longer term decisions, although I recommend it all day, every day. But when you focus on investing, it's situations like this are very interesting. How have you constructed a portfolio to be genius? Yeah, now it's a challenge. It's a puzzle. Hey, stock market's down 10%. Oh, really? Yeah. You're just chewing on anything. Oh, really? You're doing your thing. I don't even know the mannerism. But anyways, you're like, yeah, well, I'm good. I'm good. I don't like it, but I'm good. I'm fine. It'll be great. Okay, and I think you'll like that, the challenge of it, and the mathematics of it. All right, so let's take a look at the world. Commodities, obviously. You know, at one point, I was wondering if we were going to re-enter a new super cycle, but war and famine. Well, I guess famine would be normal; it's nature. But war being an exogenous supply shock, which means outside the norms of macroeconomics, sort of distort. It's a distortion, but I wouldn't be shocked if we go into like another 10 years of, global. How about this? If global GDP improves, stabilizes, which I think it has been, and then slowly grows over the next few years. So let's say we get to 2030 and global GDP has been climbing. I don't think we're going to get an increase in humanity. I don't think we're going to double in size. I think what will happen is we'll have less farmers, more people in cities, more people living longer, more families getting smaller, more focus on education, and maybe we have a shortage of things like food because the diets have improved. Okay, maybe. And then at some point, I honestly believe we'll have automated farming. And I've talked about this before. We don't need to go there again. Okay. Yeah, well, in general, Richard, if I were to focus on risk in general, down would be correct. Not just for gold, but in aggregate. But yes, you can go to the fundamentals tab and pull that up anytime you want. But in general, if you're going to consider aggregate, yeah, I would make that assumption. Right? But remember, March and February, January, that's all dead now. And for about the last 3 weeks, my prime focus has been April, May, June. even though we were in sort of the middle of March, I didn't care anymore. So I think if I were to remember now, the markets were going to drop to 62 for us to buy around April 1st. Okay. That's our plan. We've had this plan since the beginning of the year. Look how close we are now. So am I ready, willing, and able? Do I have the strength to get out of bed and do what needs to get done? Is that close enough, or do I need it priced to perfection? Hey, Richard, we have a new webinar at TRADARS at 4 p.m. in the afternoons at the New York close. Swing on by, man. That's where I could really do a deep dive for you. Okay. But this has been drawn for a while. These numbers, these lines in the sand have been there specifically since January 1st, but roughly since November of last year. It would have been pretty close to this. Okay. So in January, February, March, the Council of Investment Advisors that I lead, we just talk about the stock market coming down because that's just totally what we expect. And it's not even a debate or a guess or anything. It's just like, oh, yeah. Well, this is going to come down. So how do you want to position the portfolio? What's going to be threatened? What's not going to be threatened? What should we sell now high? So we sold assets up here to go to cash. And then we're like, well, where do we want to put the cash? Because we expect the stock market to fall. Yep. Okay. And then even in the last meeting, we're like, okay, even though it hadn't even really fallen yet, we're like, okay, well, somewhere around April, we want to start buying. By then, the stock market would have declined pretty significantly. And so we'll start to buy the dip. Cool. What do we want to buy? Now, think about that. This is what we're talking about in February and March. The assumption is the risk is to the downside and is probably going to happen. So how do we want to position ourselves? What do we want to take profit? Where do we want to hide? When and where do we want to redeploy the capital? And dude, it's just like there's no way this is magic. And it's not like we knew there was going to be a war. So when you're watching TV and they're on, or you're watching some YouTube guru and they're like, oh, the market is down because of the war, or because Trump is an idiot, or because of Israel, because of the Chinese, because they don't just say, well, because it's supposed to be. Right, Grumpy Cat? Grumpy Cat says similar setup to last year. Well, every year. Now, what you might be referring to, Grumpy Cat, is Liberation Day. Okay, that's an exogenous shock. That's not macroeconomics. So, could I be so bold to say I predicted the stock market was going to drop on Liberation Day? Well, I didn't know what he was going to announce. Now, the thought was the risk was probably to the downside. So, really, at the end of the day, it wasn't shocker. But you know what I did predict? Buying the bottom. Yeah, Greg. Well, that is the purpose, right? And I'm trying to figure it out too. So I don't know if you mean referencing what my opinion is or just referencing my ability to read the market to try to understand what other people are thinking, right? So anyway, so Liberation Day last year, we got to like a 20% decline in the stock market. I'm in the Caribbean. I'm in flip-flops and shorts. I tell my wife and kids, hey, it's Sunday afternoon. The sun is setting. Asia's going to open. It's the Sunday/Monday after Liberation Day. I got to go. I grab my laptop because I took it with me to the Caribbean so I can make this trade. Then I saunter down to the beach. I get a cocktail. I get a Cuban cigar. I find a nice place with a view of the water breaking onto the sand and the sun is setting. Gorgeous. Okay, I open up. I connected to the hotel Wi-Fi with my laptop. Oh, 20 minutes until the stock market opened. Sorry, the Forex open, right? Because it's Sunday afternoon. I sucked down my tequila sunrise, and I'm puffing on my cigar. 3 minutes ago, 2 minutes to go, 1 minute to go. Ding, 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 ding. Boom. Huge gap. Bought it. Done. Close the laptop. Yeah, I had to work for over 5 minutes on that one. But I had already predefined the prices. You know, I used annual pivot points and stuff like that, right? Like, you don't have to be a rocket surgeon. So anyway, so that would be more of the predictive side, right, Grumpy Cat? But a trader is a trader is a trader. The lesson is I go on vacation with my wife and children, and I'm ready, willing, and able to do what needs to get done. Yeah. I'm ready for the gap. And I hit my price. Chow. Yeah. Yes, Richard, in the seasonality radar, there's a tab that allows you to change the view. So it'll show you like a monthly view and an annual view. And so when you look at the monthly view, what I've asked Aiden to calculate is not just the monthly does March tend to go up and down, and monthly does April tend to go up and down, but also do it weekly, so we can see which week does the down start to stabilize and then eventually turn up, because let's say March is a down month and April is an up month. When does that shift occur? And so we do that, which means we have to do weekly analysis going back 20 years. Yeah, Greg. Well, that's the beauty of a community, right? Yeah, that's definitely the beauty of a community. This is why I pop those surveys every day. It's important to find out what other people are thinking. So anyway, so we have 6,200 labeled 3 months in advance. Right. Yeah, yeah. Hang on. Let me Kari, hang on. Yes, that is right. TRADARS.com. Let me just walk you through, make sure everything's golden. Okay, you see where it says click here? You click here. Cool. Yeah. Here's our recordings. Here's our live webinars. So I have one at 4 in the afternoon today. Here's the rebate program. Cool. And you go to the analytics platform. See? See how this updates constantly. Yeah, look at that. VIX down almost 7% now. Cool. You see how awesome that is? Okay, Kari? Let's see. He was working on this today. Bullshit. Okay. Bullshit. Yeah, this is so funny. It's just like, I wonder what's going on because if this fails, this is good. This fails. This doesn't even load. Yeah, it looks to me like there's different things going on, but why would it be different if they're all doing the same? You're just changing the price and the time, right? It's so it's really interesting how artificial intelligence works, but some of it looks okay. We're updating it, and that's why. In fact, I'm. This is still TRADARS 2.0. I should reference that. This is TRADARS 2.0, but I'm 90% done to 2.5, and then we can, yeah. So anyway, that's why it's a little buggy, but it's interesting. It shouldn't be. I don't know what it changed from 3 days ago, you know, but let's check and see if what we have here. So, what pair was that? Was that Aussie? Yeah. Boop, boop, boop. Pivots USD. Suddenly, out of the blue, we're risk on. This makes sense, right? That's following our plan. Here's our potential role reversal, but the lower high really puts that at risk. But dollar being weak on this idea of risk on again. All right, all right. But I want to check Aussie just quickly here. 68, 68.84. Where did 68.84, 68.85? Okay, the price is right. 60. Yes. So that's projecting out to April 14. That's 2 weeks. And this is showing 68.46, but the chart is 68.85. Yeah, so there's a lag. All right. But like I said, this is already the old version. The current version is already the old version because we already have a new version. So we'll get to that. So it'd be interesting if suddenly out of the blue, dollar weakens on a risk on thing, which would be seasonal, but with geopolitics, it seems like a bit of a guess, but you know. We can go to stock market here. So if we stay with risk on, here we go. If we stay on the risk on theme today, yeah, then we're at these buy the dip type things. In fact, I covered these yesterday at the afternoon webinar at TRADARS. And boy, we got close to some of these. Like this one, we got into the, you know, let's call it 4,500. Yeah. Now our number would have been closer to 44, 4444, but we have it highlighted on the no diggity no Dow. Okay, as a roll reversal. You see? Handy dandy drawing tool. You see? Okay, that's a real level of support. Now the other lines are similar. They're calculating implied volatility, but they're pretty close. You see? Sort of a confluence, if you will. So if the risk goes away, I would say we would be here by July 1st and here by December 31st. What do you think about that? Hard to do it with geopolitics. Right? Now, I think you're going to need a Republican win as well. Okay? Because that keeps a majority, which means things actually get done. If we get into a stalemate, even worse than we have now, like nothing can get passed, then that's not good for the economy. Okay. Yeah, not good for the economy. Yeah. So Mayor Mandami, who is taken over New York City, and he is a socialist pig dog by his own, not admission. It's like he references himself, right? Socialist pig. Okay. Now I'm not. I'm a capitalist big dog. That's all right. So then we can love to not love each other, but we definitely have differences of opinions, right? And so one of the things that caught my eye or my ear really this morning was based on one of his campaign promises for New York City when he was running for mayor as a socialist. Not even as a Democrat, just straight up socialist, right? All right. Well, I don't like socialism. Or I don't like socialism. How about that? Okay. So one of the things is he's like, oh, well, free childcare. Okay, I admit childcare is a problem. But the government making it free scares the bejesus out of it. Now I think about government controlled insane asylums and stuff like that. But for your children, I don't like that. Also, the idea of the free, but the government doesn't have any money, so it can't be free. You got to have high taxes. You just have to. So anyway, so the report comes out today, and again, if you disagree with me, I'm not trying to make a political statement, right? It's just as someone educated in economics, I know there's choices and trade-offs. I would make different choices, but whatever. Okay, I'm not getting all, I ain't getting all. But as an economist and as a capitalist pig dog, you have to understand my rationale and my reasoning. I'm going to think like a capitalist pig dog, right? They have spent $10 million or just signed a deal for I think it's the government workers of New York City. Ha, ha, ha. Scares me too. But the government workers in New York City are going to be the first ones to get free childcare. So they are renovating a building. They just signed the deal. They're going to renovate a building nearby and turn it into a daycare facility, for lack of a better word, right? Hey, it's $10 million. For how many kids? 40. $10 million for 40 kids. That's just the renovation of the building. That doesn't include everything else: insurance, food, employees, benefits, insurance. And I'm like, that sounds like a lot of money. Wow. Wow. Wowzer. But then again, I guess you could say, well, Wayne, what is that? One cruise missile? Two cruise missiles? What do you care? I'm like, all right. All right. See? Consequences and choices, right? Remember, economics is simply the social study of scarcity. Crypto's been bearish for a while. Is there any sign of healing? Yeah, just barely, huh? Just barely. Another way you can draw this is like draw it off the gap. See, there's a gap right there. So when are we going to buy some crypto? Soon, I think. Right now, when I look at the chart, it's bearish. What can I say? It's bearish. So I can't buy it now. But I think sometime soon we could consider it. So if we go to last year, for example, we had January, February, March, and in the second week of April, up. Now, I think the beginning of April was Liberation. So here we are now, January, February, March, and we're entering April, right? So do you see my rationale? Like, this is why with seasonality, we go back 20 years now. Crypto hasn't been around that long, in particular crypto futures and stuff. But when it comes to seasonality, imagine that I do this for every single G7 currency pair, maybe even G10. So 75 pairs. We do this for gold and oil. and copper and soybeans, right? We do this for the Dow, the S&P 500, the NASDAQ, the Russell, the DAX, the Nikkei, the FTSE. Okay, like you want to know all of this because we don't know if up, because this year is not the same as last year. We don't have a liberation day, or maybe we do. Maybe the United States liberates Iran. Whatever, dude. But wouldn't it be interesting if you were at least looking at your chart, because perception creates reality. So your perception is it could possibly go from bearish to bullish sometime now, because last year it did, but what if it did every year? Okay, that's the power of seasonality, eh, Bruce? So this is why I say, oh, I wonder. I wonder if it's going to turn north. I wonder if we're going to buy it. Well, it's plausible, isn't it? Cool. Well, the thing is, you have to be plausing it. It's plausible, but are you plausing? How much plause have you done? So why don't you give me an asset here for us to plause? What asset or currency pair or stock indice should we talk about? Should we talk about euro dollar? WTI? Let me show you oil. I'm going to show you oil. Okay? Now we know this is not a normal year. However, let me show you WTI. If you go back 20 years, we have the 5-year average for every month, the 10-year average for every month, the 20-year average for every month, and then create an exponential moving average. Why? Because I got an idea and I'm like, oh, I need an EMA of the averages. I don't know why. I just did. Because I'm boss. Okay, great. Whatever. All right. So we do a couple of things. Here's the year of oil in advance. Here's what's actually happening in oil right now. And then based on this data and a whole bunch of other data, what do we project oil to be into the future? Currently, okay, $93.37 at the end of the year. Remember, it's not calculating war. It's just saying, based on what's been happening, plus seasonality, plus standard deviation, plus global GDP outlooks from OPEC, from IMF, from the World Bank, from the OECD, all this kind of stuff, right? Yeah. In a range of 75 to 111, meaning there is a plausibility that we do continue to go up based on what has happened in the recent past for price. Okay? But then we use the normal shape, so we create curves in our linear projections, influenced, if you think about it as space-time. So, I mean, dude, I used to work at NASA, right? So I think of the price-time continuum the same as the space-time continuum, price time. Okay? And then you get gravity, which can bend and twist space-time. So we're bending and twisting our linear projection of what has been happening to price, but then we bend and twist it with our gravitational forces of normality, meaning when does it typically fall, when does it typically rise, when does it typically fall, and then we bend the straight line and shape it, and then calculate our standard deviation from that. So it's a warped linear projection. So it's a non-linear projection based on weekly data points going back 20 years, broken into months. Hey, what a good idea, everybody. So this chart to the right will actually be radically different next year. It's responding every day. Isn't this cool? Yeah. So what do you notice in some of these things? Up, 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 stop going up. Has anyone here in the chat ever heard from me that I stopped buying oil on Canada Day? How many people just know this? That peak demand ends on Canada Day. You either know this or you don't know this. And by the way, I didn't make it up in the last 2 months. If you were hanging with me 20 years ago, we also knew back then, okay, peak demand July 1st. Okay, we got one person knows. Anybody else know? It's a shame if you don't. Oh, well, just me and Denise, yeah. Samu, yeah. Yep. Canada Day, really? 3 people? 4 people? That's it? What about everybody else? Why don't you know? Really? I've known this for 20-something years. Now, back then, my good and dear friend Kurt Worley had a master's degree in applied statistics. So I said, Kurt, I want you to be my quant. He's like, what do you need? I said, go to the EIA website, find a data set showing supply and demand of oil inventories and go back as far as you possibly can. So he worked on it for weeks, and then he came back and he's like, I was able to find a data set and clean it all up. It goes back 50 years, and I've been analyzing it, and here's the data that I found. And suddenly he and I were able to talk about it and figure out ways we could use it at that time at FX Bootcamp to coach people on how and when to trade energy. And so since then, and I'm telling you, it was pretty gosh darn close 20 years ago, we've been talking about July 1st. Now it takes seconds, not weeks. And you can see it. Doop, 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 doop. Okay. It's a little different in the last 5 years. Well, the last 5 years have been a little different, like COVID. Okay. We're still impacted by COVID slowdowns and stuff, right? 10-year average, 20-year average, EMAs to make it a little more sensitive to the reason I did the EMA, just so you know. You take the 20-year average, but I'm like, dude, 20 years ago was a long time. So influence the data set to be more sensitive to the more recent price action. Right? Yeah, where have you been, Sophie? Time to go for some cigars. Yeah. So holy smokes, right? So take the 20-year, but make it a little more sensitive on the front end. So weight the 5 higher than the 20. You see? And I could do that for a 10. I just like at some point, dude, make a freaking decision. You're going to buy it or not. So look at all the green up until June and look at all the red. So if you were just to let's say you're number blind, all you see is colors, which is most people, right? Yeah, well, are they old enough to smoke cigars? Yeah. Okay, so look, if you're number blind but only see colors, let's see. Green, 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 green. Red, 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 green. So, let's see. Maybe you are a rocket surgeon. You could say up, 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 not up, not up, not up, not up. No, that sounds about right. That's when I first started smoking cigars. Yeah, seems right. He had 9 months. I was living in public housing. No, that's not true. But 2.5? Yeah, probably a 2.5. I was living in public housing. Yeah, that's where I got my gangster attitude. Yeah, the mean streets of Calgary, Alberta, huh? That's why you better back the truck up if I'm upset. Gonna cut a. It was funny. My wife was at a club meeting or something, and she came back and we were talking about it, and she said something about, you know, another woman had done something that she didn't like, and I'm like, ooh, you got to cut a bitch. She's like, what did you say? Oh man, if it were me, you don't put up with that. Got to cut a bitch. That's it. Anyways, I'm having too much fun. Sorry, I'm on 3 liters of coffee already. All right. So, anyways, so you're number blind, but you can see colors, right? Yeah. So there we are. Now, of course, this is going to keep changing based on what's happening in reality. So we're taking mathematics, which is a model that represents the represents reality, huh? But it's not reality. It represents reality up until now. And then everything else is hypotheses. So the cool thing about Aiden is, like, to do this, I mean, dude, you need thousands of data points, right? I mean, a human just can't do it in the mind. Although I do it in my mind, but for 20 years I couldn't prove it. So think of it as a rule of thumb. You know, what would Wayne normally do? Okay? Versus this is exactly the math. Still doesn't predict the future, but it just confirms the methodology. So Aiden every day is going to look at 1,000 different things and then update our linear projection, our non-linear projection. Now, I hope you appreciate linear projection, but the fact that we have this much data and can produce nonlinear projections, I hope you understand that we've gone from an algorithm to straight up artificial intelligence. Okay? I'll give you another example of, of the power of what we're doing. I'm cleaning up our database to make it faster. And I did an audit and found that gold was inefficient. So I analyzed so think of our mainframe that stores everything. So imagine there's a little drawer full of gold, but it's all messy. So obviously, if it was organized, you could get the data faster and stuff. Okay? So for just gold, yesterday, I deleted 4,700,000 records for XAU. So now if you think about, we have this for every asset, dude, like, it's insane. Okay. Cool. So anyways, we don't really, having analyzed, this is what I was talking about earlier, having analyzed this data for oil, it's statistically unclear when oil decides to do what it wants to do. Does it, let's say April was up. It's actually April is down. You see this? April is down. But when does it fall? You see, like the difference between March is up, April's down. When does that occur? And we've analyzed weekly data going back 20 years. So imagine you have 5 months in March, 5 weeks in March, because March can be a big month, and then 4 weeks in April. So there's 9 weeks. And you look at the same 9 weeks going back 20 years, analyzing each week individually, and then creating statistical analysis of each week. Is each week up or down, up or down? You know, sometimes, if not most of the time, we find out in this analysis if March is a up month, when does it tend to peak? Which week does it tend to peak? And then when does it start to turn bearish? And then if April is bearish and May is flat and June is up, when does that peak and trough get produced? You know, this is what I'm asking it. Like when we got all the data, I'm like, this is what I need to know. And I think this is what you need to know. When does the peak and trough tend to form statistically if we're able to do a look back that far and then calculate the averages? And so the peak to valley, so we know March is up, April's down, but having done that analysis, there isn't any consistent, repeatable pattern of when it peaks and goes bearish. Oh, now we're still technically in March. So tomorrow, that March data will go away. We'll be in April. And the analysis will update because then we'll know April has been a bearish month. But then the next question is, okay, if April's down, May is flat, that means at some point it goes from down to no longer down. And then June is up. So from the bottom in April to a peak in June is, I could say, is it the third week of April we trough, and then we run it all the way up to the end of June, which is July 1st is Canada Day. So somewhere near the end of June, is that when we're supposed to take profit? When do we get in? When do we take profit? And that's what Aiden is doing. So tomorrow you would just have to click on this and he'll tell you. So April will be over here instead of March. And then we'll already have May, and he'll analyze week by week. When does it tend to flip? And look at the vol. Sometimes oil is down 5%, but sometimes it's up 14.5%. It shows you your downside risk based on standard deviation and upside potential if you're a bull in a bullish month, which means this spike, okay, we know it's war related, but it's not abnormal in the direction and the magnitude. Like, it's saying if you go back 30 years, oil going up 14% would be the high end of of normality, but it wouldn't be abnormal. Now we know oil's gone up much more than that, but what we're talking about is the normal standard deviation. This is why you have 5-year, 10-year, and 20-year, because that will have a big impact on our 5-year average, but it'll have a very small impact on the 20-year. Because, okay, having oil double in March, that's unusual. Having oil go up in March is normal. You see how cool this is? So we use this information, and let's see if he fixed something for me. I haven't looked at this, so I apologize if it doesn't load. I know it works on 2.5. Yeah. Oh, shit. Part of my French. Oh! Yeah. Wow. Okay. Wow, look at this. He has it going up to like $300, $350 a barrel. All right. Well, this is just showing you how wacko, not Aiden is, how wacko the markets are. Because, and by the way, this is where I got the idea for nonlinear projection. So what Aiden is doing here is looking at price going back to May 27th of last year. So let's say June of last year. Okay. Going back at June, he's analyzing the mean price and then over time adjusting the mean price. And then calculating the slope of that mean as it changes over time. The reason you do that is to say bullish or bear. What is price doing? Okay. All right. And we've been bullish since January 15th, I think it was. Third week of January. The 21st of January is when we turned bullish. So think about it. Back then, 4 months ago, we looked backwards in this chart, and we were very bearish. Price had come down a lot. Then we roll into this year, and it's really been impacted by an early increase in price. And then, even though it doesn't look like much here, a giant spike. This is a giant spike. Okay. Look, a giant spike. So that goes into the linear projection. It's just math. Yeah. But that also spreads the standard deviation because flat, 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 flat spike. So like this was a spike and this was a crazy spike. Doesn't look like much. But if you were to push this forward, it would be over $200, almost, let's say $250 a barrel, right? Because worst case scenario, or in this case, best case scenario is even higher. But that's just one standard deviation. And this is only linear projection of what has been happening. So don't read too much into it, because what we have been happening is very unusual, isn't it? Does oil double in the month of March? No. So it's like all it's saying is from this period, that's the slope of the mean. Here's the run. Here's the rise. Okay. And that creates the slope. Slope mean boop, 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 boop. Okay. So that's where we are now. So he's taking the rise over the run here and then just projecting that forward. Are we going to have a continuation of oil going up all the way to 240? Look, I don't think so, but that's me thinking. Anything could happen. If the war continues and escalates, and the United States takes Garg Island and Iran attacks Saudi Arabia, yeah, dude, yeah, and this would change as the price changes. Remember, we're only analyzing price here, trend. So if it just keeps the way it has been, and by the way, we went from $60 a barrel to $120 a barrel in a week, and then and now we've just been moving sideways for a month. So really, as time continues, if things don't get worse, then this projection will flatten. So it's not a prediction, it's statistical analysis. If you change the data set to say only measure what's happened over the last 4 weeks and don't count the big spike, just count what's been happening since the spike, since the war has been announced, since the market has been able to get their hedges, then this might be more realistic. And you're like, that doesn't look like much. Well, it is. No, I don't know why this price is up. Okay. So then you get to where you see it's more like, I guess, what is it saying here? $155 a barrel? No, that's not right, because it's saying this up here. So anyways, it's just not putting it properly. Anyways, whatever. I think you understand that this is not likely to be here. But think about what it's doing. How does it make it helpful to you? Because you're trying to understand what is happening. And very often you're on much smaller time frames where you get lost in the noise and you don't really know what's happening. You're a foot soldier in the fog of war. Every once in a while, it's good to step back, see the forest from the trees. Here you are with satellites and AWACS, and you look and say, okay, well, this is what's going on now, but also imagine every day you log in and this is flattening and the base is falling. That's useful information. Yeah, for sure, Greg, right? And if we get there, this is accurate based on what has been happening now. We don't have our rig count. I think 2.5 has the rig count updated properly. I believe we have quite a few international rigs added, but not much in Canada and the United States, but internationally. Down here. Yeah. See, I haven't focused on this page in a bit. Loading, rig count. Yeah, don't worry about that. I'll get that fixed. Easy, easy. So we're internationally they're drilling like crazy. On this chart, for linear projections, I'm trying to like, would it be useful? I'm thinking I doubt it's useful. I think what you're getting to is like you build this and you're like, okay, but I know that that's not likely under current market conditions or what you think the future market conditions will be. It's only reacting to the shock, but you know, so you're like, okay, so what's normal? And that's what seasonality is. And then that's where I'm like, okay, how do I take that linear projection and shape it? And then you can see this is actually very useful, very helpful, huh? Right? Very helpful. And what I like about this is I don't disagree. Peak 98.50. Huh? I mean, dude, this is really nice analysis. I'll have to remind you too, just for fun, because you don't know if you're making the right decision at the time. I bought it. I guess I should do this in blue. I bought oil around 66 and I exited at $99.60. So 66.60 and 99.60. Cool. Yeah. Anywho, I feel like I've gone too long. The stock market's about to open. Remember to watch VIX. So let me get you updated on let me get you updated on the headlines and then market conditions. Gold hovers below $4,600 as traders weigh Mideast de-escalation hopes and interest rate outlook. Euro pound fluctuates as energy-led Eurozone inflation contrasts with fragile UK growth.
Gold. Correlation with oil turns supportive. Commerzbank.
Pentagon chief. U.S. has more options as Iran war nears decisive phase. Door open to deal.
US dollar Canadian dollar moved above a swing area and increases the bullish bias.
Eurozone. Rising energy shock challenges ECB ING.
Gold prices set for bruising March losses amid Iran war. U.S. January Case-Shiller 20 City House Price Index plus 1.2% versus plus 1.3%. YY expected.
Yeah, 1.2 ain't bad. It could be terrible. Before we do the sit rep, I want to remind you, okay, the training's not. I guess let's do the sit rep and then I'll show you the training.
Good morning, I am Aiden, and let us get you up to speed on the shifting macro landscape. The market is navigating a decisive risk-off environment as investors pivot toward the safety of government debt. I am seeing falling U.S. Treasury yields exerting downward pressure on the U.S. dollar, creating a relief rally for European majors like EUR and GBP. Biggest movers right now, volatility index and Bitcoin are down. Silver, gold, and platinum are up.
So I just realized that he's done this wrong. I didn't notice that before, so I apologize. Need a button. All right, should be here. I don't think I tested it. I hope it works. Yeah. Okay. Cool. This is today, March 31st at 4 o'clock. We do the New York close, technical and fundamental review. You can see I'm going. Make sure you RSVP, and you will get the link emailed to you. You can also add it to your calendar. So just a heads up. I know that that's not a very good user interface. I'll get it all cleaned up. Don't you worry. TRADARS 2.5 is going to be ready very soon. Cool. So peace on earth. May the pips be with you. May your profits be above average. Thank you, Traders Way, for amazing execution service and a brilliant MT4, MT5 offering. Brilliant, I tell you, brilliant. Peace on earth. May the pips be with you. May your profits be above average. That just happened.